So you think that growth is going to be great, 6-7% you could do on GDP. You say the economy's flush, right? Supporting high levels of consumption, right? People have saved a lot. We're ready to get out. We're ready to spend a lot of money. You don't think we're in another 2000 tech bubble, but then why have you taken your cash level much higher than it was before? What's the message in that? Is that a looking for and expecting a correction and then wanting to pounce on that, or is it something more?
You guys do some pretty good diligence on our portfolio. So what are we doing? We're running much more of a barbell today. So think about portfolio allocation. Think about how you run your portfolios. Last year, we ran a lot of interest rate risk. You had the Fed that was easing aggressively. Interest rates were A great hedge. B, you were playing alongside of they're going to drop interest rates. They're going to purchase a lot of assets. Today, that interest rate exposure is not interesting at all. In fact, a better way to dull some of the betas, dull some of the risk in the portfolio is run more of a barbell, sit in more cash. By the way, it allows you to be opportunistic around situations that manifest themselves. Run more cash, run more, and I think it was John who said it. You can actually use some of because volatility's come down. You could use some of the options market to get some of that upside exposure in with the lower volatility. Take off some of that exposure, run a higher level of cash, own some yield in the portfolio, but get out of the high quality assets I talked about. Investment grade credit in the front end of the yield curve, not interesting. Agency mortgages, not interesting. Munis today, I mean, how much money are we going to make on munis at 50, 60 basis points? So hold it in cash, be opportunistic, and dull some of the risks you have in the portfolio that way.
I'm glad you noticed we do our homework around here. We appreciate
yes, sir.
that. Liz Young has a question for you.
Hi, Rick. I want to go back to something you said about the Fed and the tapering plans. Let's imagine a scenario where corporate taxes are raised at some point this year, or at least a proposal of corporate taxes being raised. And let's imagine that puts pressure on the equity market. Does that then push out the Fed's ability to taper, even if the economy is doing okay?
That's a great question. So I'd say a couple of things about that. I do think, we model this and we look at how much taxes could increase. And you look at some of the sectors, obviously technology, some of the financials, some of managed care places. So you've got to factor into your free cash flow model, your earnings model. You've got to factor in, we are going to have higher taxes, corporate taxes, unequivocally. So anyway, I think you got to measure that. But I would say one thing about, all the years of watching the Fed and interpreting the Fed. This Fed, and generally every Fed, is laser focused on employment and improving the dynamic around what's happening to the employment paradigm today to get to maximum employment. How do we get the unemployment rate back under 5%? And I think that is, as long as inflation is not moving tangibly higher, and it's moving a bit higher today, but a lot of that is near-term exogenous impacts that are driving that. But I think they're laser focused on that. To the extent that higher taxes does cause some slowdown in companies' ability to hire, et cetera, that would factor into the equation. But boy, I really think, I always think markets spend too much time thinking about how the Fed watches markets. I think the Fed is really aggressively tuned into employment, and it's going to do everything to get to maximum employment. By the way, so is the new Secretary of the Treasury, and so is the new administration.
What are equities going to return this year, do you think?
So I think you could still get an 8 to 12% return in equities, but listen. I think the tail risk is higher. But like I say, not to say you can't pull back first, but I think the tail risk is we're going to have higher returns in equities. Like we've had last couple of years. When you had incredible monetary stimulus. Probably not, but I still think there's upside. And by the way, I think Liz said it and others have said it. There's some stocks that are already too high, that don't generate free cash flow, don't have any real or trade at multiples of revenues that are not sustainable. But I think by and large, I think you'll get a good return in equities.
Which ones are those?
I'm not supposed to say that on. So I think some of the some of the software companies I think have been identified. Not as long as on the show, but I think some of the software companies have gotten aggressively valued. Not all of them. I actually still like software. By the way, I don't think semiconductors that have had an incredible run, I don't think they're overvalued. I think there's more room. I think that's the new form of commerce, or I should say of how manufacturing commercial activity works. But I think there are parts of software that make my head spin around where people think these companies are going. that is the most aggressive place. By the way, I wouldn't disagree with some of the reopening story and some of those names that may take a bit longer for those businesses to come back as well.